Hey gang, I'm Dr. Who. This is Accounting's a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough illustration of how to properly utilize the accounting equation for transaction analysis. So if you're unfamiliar to the accounting equation or transaction analysis, I've dropped a link to a video that'll get you up to speed in no time. So with that being said, let's get it! Alright, so we have Meg McKinney open a public relations firm called Solid Gold, August 2024. Following amount summarize the business at the end of the month, August 30th. Let's see what this is. So we have some balances based on the accounting equation. Alright, cool. Then it said during September the following month, the business completed the following transactions. Okay, so we got some transactions here, easy breezy. Analyze the effects of the transactions on the accounting equation for Solid Gold. Beginning balance is given in the question, have to be entered for you, yada yada yada, blah blah blah, put zeros here. Alright, so let's get it. So basically we're going to utilize the accounting equation, which is extremely powerful for mastering how to properly use financial accounting, based on the transactions that was given for the month of September. So we started out with a beginning balance that was already provided with us, and we are going to attempt to fill out the balances as these transactions occur. When dealing with transaction analysis, gang, always focus on the keywords, because the keywords will identify most of the time the accounts that's affected. So let's take a look at the first one. Receive contribution of $17,000 cash from McKinney in exchange for common stock. So what are the keywords, gang? Cash, common stock. So basically they issue stock. What is affecting the accounting equation? Cash. Cash is affecting the accounting equation because it's coming into the business. Cash happens to be an asset, so our asset cash will increase. What about common stock? Anytime we issue common stock, we know that we are increasing our paid-in capital section of stockholders' equity. Remember, gang, stockholders' equity is broken down into two parts: paid-in capital, which is common stock, and retained earning, which is income. So, since we've issued common shares, we have more shares outstanding, so now our common stock account went up, as well as our stockholders' equity section. So, our asset account cashes went up by $17,000. There were no effects on the other asset accounts, no effects on liabilities, and our common stock account has increased by $17,000 as well. Again, the remaining parts of stockholders' equity, nothing was affected, so we're going to leave all of those blank. And so we know, gang, based on this previous transaction, that we are now finished because our assets from this transaction's value equals the value of our liabilities plus stockholders' equity. We have $17,000 increasing on the asset side, and we have $17,000 increasing on the liabilities plus equity side. So now we can move on to calculate our new balances. So we're going to take the original balance of $1,900 and we're going to add $17,000 to that. And that will give us a new balance in cash of $18,900. There was no effect in our accounts receivable balance from the transaction, so we're going to carry over that previous balance, which will give us $3,200. No effect for supplies, so we're going to just bring that zero balance down. Our land account, no effect, so we're going to carry over the $1,500. Same for our particular accounts payable, $5,000, just carrying it down. Now, we have to calculate our new common stock balance, so we're going to take the $11,900 and we're going to add the $17,000 to it. That should give us a new amount of $28,900. No effect on dividends, so we're going to just carry all of these balances down and check our answer. Bags on deck, gang. So we're going to keep this thing rolling. Perform services for a client and received $800. Perform services for a client, received $800. What are the key words? Perform service, receive cash. So, based on those two key words, perform service, remember, gang, anytime a company is providing a service or selling a product, revenue is generated. Thus, increasing our stockholders' equity section. Now, they didn't provide the service for nothing. They received cash. So that also increases our cash account, particularly adjusting our total assets value on the accounting equation by $800. And so our cash account now went up by $800. No effect on any other asset account or liability. So we're going to keep that blank. And then the only stockholders' equity portion that is being affected comes through retained earnings, particularly the revenue account. So we're going to increase our revenue account by $800. And so that would be it for the transaction analysis. Now all we have to do is calculate the new balances. So again, with the trusty calculator, we are going to take the $18,900 previous balance and we're going to add $800 to it. And that's going to give us a total of $19,700. We're going to carry over those other unadjusted amounts that was already previously there for our assets, as well as the liability, and also our equity components that wasn't adjusted. Then we're going to adjust our properly new service revenue amount. So we're going to take $3,200 and we're going to add $800 to it. And that'll give us a new balance of $4,000. And we're going to check the answer. Bags on deck. Next, it tells us paid off the beginning balance of accounts payable. What are the key words, gang? Paid and accounts payable. So remember what I told you guys. Anytime you see the word paid and the company's paid, cash is always going down automatically. So we're halfway there. We know cash is an asset. What was paid? The accounts payable. Last name payable, always a liability. So therefore our liabilities decrease because we paid on an account by the beginning balance. So we need to look at our beginning balance of accounts payable. So it seems as though, gang, our beginning balance of accounts payable is $5,000. So what we're going to do is put it in brackets because it's decreasing for $5,000. And our cash account is going to decrease as well by $5,000 because it was paid. No other accounts were affected, and our transaction analysis is complete. So now we're moving on to calculate the new ending balances. So we're going to take the $19,700 in cash and we're going to subtract $5,000. That should give us $14,700. We're going to carry over all of the unadjusted account balances previously. Our new accounts payable balance should be zero because it was paid off. And then we're going to carry over all of our equity unadjusted account balances as well. We're going to check the answer. Bags on deck. Moving on. It tells us purchase supplies from Office Max on the account, $1,200. What are the keywords, gang? Purchase supplies on the account. So we already know purchasing supplies. Supplies are assets. So our assets are going up in the business, thus increasing our asset supply account by the $1,200. But since it was bought on an account, we have to recognize that we still owe. And because we still owe, a liability must be created. What a liability? Accounts payable. Remember, gang, accounts payable is an account that is set up to pay cash in the future, which happens to make it a liability. So we're going to increase our office supplies by $1,200 and increase our liability account payable by $1,200 as well. Our transaction analysis has been complete for this particular situation, and now we can calculate our new balances. Therefore, we're going to carry over our asset account balances that weren't adjusted. Then we're going to adjust our new accounts that were affected from the transaction. So our supplies balance is now increased to $1,200, and our accounts payable liability account went up to $1,200 as well. We're going to check the answer. Bada bing. Next, collected cash from a customer on account $2,000. Okay, gang, keywords. Collected cash on an account. Again, cash is an asset, so cash is coming up because we collected it, and the other keyword was account. Now, from our previous transaction analysis, we saw the keyword was account as well, but it happened to be a payable. But in this situation, we collected cash on the account. So therefore, the account that we're dealing with is the asset called account receivables. Remember, an account receivable is an asset account that is created to receive or collect cash in the future. So in this example, we finally collected the cash. So how will this affect the accounting equation? We understand that our cash is going to increase by $2,000, causing our assets to go up, but simultaneously, it's going to cause our accounts receivable to decrease, to go down by $2,000. Why? Because we've collected on the account. No other account based on this transaction has been affected, so our transaction analysis is now complete, which brings us into filling in the new balances. So first, we're going to go ahead and fill in all the unadjusted balances. Then we're going to adjust the new balances for the two accounts that was affected from the transaction. So, trusted calculator, we're going to take the $14,700 from cash and add $2,000 to it, which will give us $16,700. And we're going to subtract $2,000 from the initial balance of $32,000, which will give us $1,200 left in accounts receivable. We're going to check the answer. Bags. Cash dividends of $1,600 were paid to stockholders. Keywords, gang. Cash dividends. Paid. So again, we know what the word paid does for us. It allows us for cash to go down. Cash is an asset. Now, dividends is by definition income distributed to shareholders. So whenever dividends is distributed, it reduces the retained earnings account, thus decreasing stockholders' equity. So our cash account will go down because we paid $1,600 to our shareholders, and our dividend simultaneously is increasing, causing stockholders' equity to go down by $1,600. So no other account is affected, so we can now move on to our ending balances. We're going to carry over all the unadjusted ending balances first. Then we're going to adjust the new adjusted amounts for the accounts that was affected. So we have a cash balance of $16,700 initially, but we just paid $1,600, so our new balance for cash should be $15,100. And our dividends account now has a balance of $1,600. We're going to check the answer. Bang. Moving on. G. Consulted for a new band and billed the client for services rendered $4,500. What are the key words, gang? Billed the client, services rendered. Again, anytime you hear the word services rendered, you're providing a service or selling a product, you're generating revenues. Revenues is going up, thus causing retained earnings to be affected as well, because revenues is a product of income. Remember, gang, income is always revenues minus expenses. And since retained earnings is income, it is affected as well. Retained earnings happens to be a part of stockholders' equity, causing it to go up. So the fact that we bill the client means that we haven't received cash for the services. So therefore, we have to set up an account receivable, which happens to be an asset. So our accounts receivable asset will be affected, increasing by $4,500 because we billed the client. And our service revenue has been earned, thus increasing our service revenue account by $4,500 as well. We are done with transaction analysis of the accounts that was affected. So now we could go and calculate our new balances. First, we're going to input all the unadjusted balance amounts. Then we're going to calculate the new balances for the accounts that was affected. So our accounts receivable started out with $1,200 and we increased it by $4,500. Gives us a new balance amount of $5,700, and our service revenue started out with $4,000. We increased it by $4,500. So now we have a total balance of $8,500. Check the answer. We're almost there, gang. Last but not least, recorded the following business expenses for the month: paid rent, paid advertising. Here's the deal. We have two separate individual expenses that incurred for the month. Remember, gang, expenses affect income because income is measured by revenues minus expenses. Since expenses affect income, it does also affect retained earnings, which happens to be a part of stockholders' equity. So we have two separate expense accounts, rent and advertisement, that is causing our stockholders' equity to go down. We paid for both of them, gang, which means cash is going to decrease based on paying each expense. So we have rent for $1,000, which was paid, so we have to make it negative. And we also have advertising, which was paid for $500. Our rent expense went up by $1,000, as well as our advertising expense of $500. Now we've completed the transaction analysis for this particular situation. We can calculate our new balances. We're going to go ahead and update all the unadjusted balance accounts. Then we're going to calculate the new balances for those accounts that was affected. So we had initial cash balance of $15,100, and we decreased cash by a total of $1,500. So that would give us a balance of $13,600. Our rent expense has now increased by $1,000, as well as our advertising by $500. We're going to check the answer. Bags. So that's it, gang. A simple but detailed illustration of how to properly utilize transaction analysis when approaching the accounting equation. This is very critical that you understand the fundamentals of accounting because it carries on throughout your career or your knowledge base. So hopefully you understood everything was going on, and if so, please like, subscribe, and share the channel with your friends so they can get the bag too as well. I'm Dr. Who, and it's always a pleasure. See you soon.